Progress. All right. Good evening, everyone. Thank you for joining us this evening. It is an honor to have you with us. My name is Dr. Aiden Brown, and I am the president for the ADSLPro, Association of DSL Professionals. And we're joined this evening by our esteemed guest, Mr. Kudarie Somaru. I hope I pronounced it correct, Kudarie. Thank you
You
very
got it.
much. And just a little bit about Kudarie, a quick wit-headed, service-driven financial advocate who has a powerful mission, educating others on how to build generational wealth through life insurance and financial services. He exemplifies a passionate spirit of enthusiasm and authority. From growing up in in a army household, right, to graduating from the University of Central Florida, UCF, that's here in Florida, as you know, Central Florida, to leading conversations around legacy and wealth in the community. Kudarie's journey is one of faith, service, connection, and what it means to build a life of significance in an altruistic field of work. So, with that being said, I will now hand over to Kodari as our theme for tonight. And let me add that our theme for this evening that we will be looking at is understanding the language of life insurance, what every leader must know. And you don't have to serve in a leadership capacity in an organization, wherever or whatever. But as long as you are a leader in your own rights, you should and know and have information on life insurance. So I will now open the floor for Kudari to take it away.
All right. Thank you for the introduction. I appreciate that, Dr. Brown. By the way,
You are
this
welcome.
this is not cognac. This is sweet tea. Just throwing it out there for the audience, right?
Thanks.
Just in case. But I appreciate the introduction. I do appreciate the welcome to be in a space where I get to speak about something that I find near and dear to not only our hearts, but our minds, our finances, and our futures because they're all tied in with one another. As he said, my name is Kudarie Somaru. I also go by KD. And I wanted to speak about not only the importance of my expertise in regards to helping people do a number of different things. But in life insurance, I speak of this as not only just something that you hear about in the commercials or online, but this is literally the Swiss Army knife of finance. And what I mean by that is there are a lot of different tools and utility that can come from this very one item. So I'm going to be able to speak to that. I'm going to go ahead and jump right into sharing my screen and giving a overview about the things that you can use as a leader, not only in your business, in your household, in your family, amongst your peers, or in whatever space. Everybody has the capacity to be a leader. So within that, we have things that we want to protect, that we want to account for when it comes down to a number of things. So bear with me one moment while I get this reset and while I get us underway. Oh, that's not it. Zoom, share, lock in, share. And Dr. Brown, do you see my presentation? Is it up? A thumbs up?
Yes, yes, I'm seeing your presentation. I'm sorry. Yes.
Okay.
Janice and TJ, are you seeing? You can just give us a thumbs up if you're seeing, please.
Either a thumbs up or you can put something in the comments. Just want to make sure that
Right.
the
We're
guests
all
that we have
seeing.
now are here on board. All right, thumbs up. We got one. So what every
Yeah, I
leader
don't think
must
TJ
know.
is. I'm sorry, Kudari. I don't think TJ is seeing it, but I know Janice. Oh, perfect. But TJ said don't see it.
Don't see it. Oh, never mind. I got a thumbs up.
Okay.
Excellent. Okay. So what we're gonna do throughout the slides as well. Don't mind the date. The date's off. Just update it to today in your mind. But I do have my QR code that's available here. So if anybody that has my information, whether to reach out on Instagram at IJS_KD, also have my email, or I also have my number listed on there as well as my office address. If you want to scan that QR code, get my information, you can send me your information as well. So if anything comes up that could be of service or value to anyone you know, love, trust, and care about, please feel free to go ahead and reach out and we'd love to entertain that conversation. So going into life insurance, think about what do you value most financially? And as we're talking about the language of life insurance, here's just some simple terms that we can start um just having an understanding of what life insurance, what life insurance is. I'm trying to minimize myself out the way. All right. So life insurance, as it says, it's a promise to pay a specified sum of money to beneficiaries upon the passing of the insured individual. This is a contract that is going to be able to establish this promise within either a certain period of time or at the time that someone passes. What is being passed along is the face value, also known as the death benefit. This is the amount of money that's paid to the beneficiary upon the passing of the insured, leading to the beneficiary. It's either the person or the entity that is designated to receive that benefit upon the insured's passing. That beneficiary as an entity could be your trust. It could be a trust that you set up with an attorney for your family. That entity could be your church that you set up to be able to give to that next generation, or it could be several different individuals that you either know, love, trust, and care about. The premium is the amount of money that you are using to be able to have this insurance policy put into force. A rider is in addition to the life insurance policy, which can provide some additional features, and we'll definitely touch on that a bit later. But I like to tell clients when I'm speaking with them that life insurance is not like going and buying a cup of coffee. You can't just say, let me get two of those, one of these, a little add an extra this. It doesn't work that simply. So the way that it works is it has to go through an underwriting process, which is what a process that the insurers use to assess the risk associated with insuring a particular individual and determine eligibility. I myself, I'm actually an insurance broker, so I don't go to just one company and I can only offer the best thing that they're able to offer. But we have the top insurance carriers in the country that I have an affiliation with to be able to shop around and to find whatever product makes the most sense for you based on underwriting, based on value, and based on your needs. So when it comes down to this, right? The what people should really keep in mind is what are the solutions that we are solving for? What are the problems? Because at the end of the day, something value is tied to the service that it provides. What is it actually doing for you? So we have to think, how much life insurance do you actually need? And what this is called the dime method. And which this is a calculation that can be used to find out at least a rule of thumb, how much coverage do I actually need? So your debt, anything from your credit card balances, car loans, student loans, any other loans that would need to be repaid, if your if and when you were to pass away, your income, as far as an income replacement, when you are no longer here, when you are no longer here, what is the income and the lifestyle that's going to be left on to your loved ones? So normally a rule of thumb is 8 to 12. We nice to pick a nice number of like 10x of your annual income to be passed along to your family. The mortgage. We want to make sure if anything else, what is the amount of time that your family would be able to go without until they reach a financial shortfall? And when you think about all of these challenges, at least having a roof over their head, the household taken care of, whether you are owning or even renting for a number of years, we want to make sure that the family is at least indemnified, which means that they're in as good a space as they can be with their household. And then in education. Of course, it can vary from education from the top to the bottom. When I like to speak with people, I say normally $100,000 per kid if you were to count everything so that they don't have to work a job, their rent is covered, they have food, they have books, they have classes, and they can possibly even go as far along as to getting their doctorate in strategic leadership. Right? I'm pretty sure that you'd appreciate that. But we want to make sure that this money is there so that we can ensure that whatever direction our children or the next generation is going to from a higher education standpoint or maybe even a business standpoint, that we have a sum of money that could be available for them to be able to utilize. So when what I mentioned earlier, how valuable can this be? And really that comes down to what are the problems, the pitfalls, and the perils that you really want to solve for? Because the bigger the problem, the greater the need for the solution. So when you're thinking about these are five different areas that I'm going to get into. as far as the things that you would want to either avoid or to address, as far as problems, perils, and pitfalls go, when you're coming up with a prosperous financial plan, leading your household, leading in the financial space, and leading yourself from now to the future that you want to have. You want to be able to avoid procrastination. And what it is just delaying or postponing something. Think about when you would like to retire and why is it that people wait? Normally because they have a lack of clarity. And the benefit of having life insurance in place is that you know that at some point in time, this is a net profit that is going to be going to your family or your beneficiaries within either a certain window of time or at the end of times. So when you don't really know where you're going, it's kind of like driving through the fog. How fast do you normally go when you don't know where you're going? Another challenge with procrastination is the false productivity. If you keep spending time getting ready to get ready, that's like spending all of this time doing all your research and looking and trying to find things for yourself in regards to the coverage that you need. And you spend all this time that unfortunately the time could come that it's too late to be able to get it. When it comes down to at the end of the day, some coverage is better than no coverage. So if you have this at your job, that's a great start. If you have this from a friend, a family member, a trusted peer, or professional, it's good to have something in place because you miss 100% of the shots that you don't take. And at the end of the day, it's better to have something and to be educated along the way to find out what you can best lock in. Don't get overwhelmed by the information that could be out there, right? Because normally, if you stay stuck and in the position that you're at right now, and you do not have enough coverage in place, you do not have all of the other following areas addressed that can help you lead to that prosperous financial future that you're looking to get to, and you stay in place when these other occurrences or conditions present themselves, that could be a mighty big problem for you. So it's best to be able to act. And there is no such thing as the perfect time. The best time to get life insurance is yesterday. The second best time is today. You won't be able to beat that. So, what are one of the other problems? Or actually, compound interest. You want to be able to put time on your side. So, compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. Albert Einstein. So, to break that down, if you're looking at when you want to be able to have a prosperous plan in place, there is a cost associated with waiting. Now, I'm going to get more into the details of how we're able to leverage this and to use this, but this is just a overarching um, breakdown of what it is that if you take more time to be able to wait to set yourself up from now and into the future, whether it's financially or just to have peace of mind. But the longer you wait, the multiples more of what it could take for you to be able to get to where you want to go. So let's just say that you want to retire with $1 million. And if you are saving that money in any other format, making just 8%, not accounting for taxes or anything else, just to have that $1 million, this is the chart here. If you had 40 years until retirement, you're saving nearly $300 a month. At that return, you can have $1 million. But if you just wait another 10 years, which is only 25% of that time, at 30 years, you're paying nearly 2.5 times what you would have paid if you had just started sooner. So when you're looking at this information with the problems, the perils, and the pitfalls, there's no better time than today to make sure that you are addressing that, to make sure that our most important assets are taken care of, which is our family, which is our finances, and our future. Someone's sitting in the shade today because someone planted a tree a long time ago. Warren Buffett. What tree is being planted for your seeds to come, or to your family, or for the future you that you're working towards? So these next four things I'd like to keep in mind, I use the acronym TILL, T-I-L-L. The first being that what do we want to make sure that we're accounting for, and how could this possibly serve you as a leader in your household? We want to make sure that we're accounting for taxes. So when it comes down to the taxes, there's essentially three buckets. You have your tax now bucket, your tax later, and your tax never. So your working capital, when you're going your job, you're collecting your money, you're offering your services. You normally have your checkings, you're putting that in stocks, you have your mutual funds. That's money that once you draw upon it or once you have it, that's taxed right there in the moment. But what do the majority of people have? Normally they have a 401k, an IRA, or one of those other three number and one letter plans, such as your 403b or a TSP, or something that essentially says that this money isn't going to be taxed now, but is going to be taxed later or tax deferred. And then you have your tax never bucket, such as your Roth IRA, your health savings account, or dot, dot, dot. Where do you think a majority of Americans have their retirement savings? their long-term savings, their end of the road, their golden year funds. If you thought what I thought, it's normally in the tax later bucket. But let me ask you this. Legally, I can't say, but do you think taxes are going to be higher or lower in the future? Now, let's just say that you thought that they're going to be higher. If you're putting more money aside today to have to pay more taxes on it in the future, how much does that really leave you with when the time comes? We don't know. So if you're looking at the areas that you want to be able to have your money, which bucket makes the most sense for you to have set aside to be able to make sure that it's taking care of you? I'll let you decide. Moving on. Oh, actually, well, just to further that, speak about the unnecessary taxes. Once I said, there's the three buckets. You have the future of taxes. There's something called RMDs, which is a required minimum distribution. What you want to think about in your entire financial portfolio, if you have it in a 401k, an IRA, they have something called a minimum distribution, which means at what they recently made 73 years old, you have to take out a certain amount of money or be penalized. It used to be 50%, but now it's 25%. So if you had to take out $1,000 and you don't, you can be penalized 25% of that $1,000 or the amount you did not take out on your money. So at the end of the day, once again, how much are you looking to leave for you? And when it comes down to Social Security, in 1935, the average man lived to 60 years old and the woman lived to 64. The full benefit wasn't given until 65. So when you're thinking about down the road, you're thinking about your money. At one point in time, when they gave us Social Security, when they gave us this guaranteed income that we know was going to be there for us month over month, year over year for the rest of our lives, it wasn't even designed for us to be alive by the time that we got it. So keep in mind what's actually going to be there when you need it, and will that be enough to take care of you? A man known as America's CPA, Ed Slott, amazing quote, your IRA is an IOU to the IRS. Keep that in mind because we don't know where things are going to be. Romalis Gandhi is a coach of mine, and early on in my career, almost coming into 4 years within this industry on this beautiful platform, Romalis said, America was built for businesses and not employees. I said, because when you think about it, at the end of the day, a tax deduction is for doing something that is helping keep the ball rolling for the business of America. If you don't have the deductions, if they're just taking it out and you're not able to do something else, you're getting the benefit for doing something that continues to keep the system going. But if you're not doing that, what position does that put you in? When you're thinking about your financial plan, and maybe this is never a thought that came to mind to you, but thinking about life insurance, think about inflation. How much money is being set aside, and what is that money being set aside for? What is it going to be worth from a buying perspective when it's actually being utilized? Inflation is known as the silent tax because in 1980, $100,000 today would be $383,000. So imagine what will $100,000 really be worth from a value standpoint and be able to buy 20 years from now? Wherever you're putting your money, if you're not keeping up with inflation, you're falling behind. So you need to, my suggestion would be review your spending. You could possibly minimize your lifestyle, discuss it with the professional, put your money in places to where you are outpacing inflation. And if anything, look to be able to generate more income. Once you've carved out your Mississippi River, which is your main thing, your go-to avenue for generating income, it's always good to have those other streams that come from there as well to make sure that we're putting ourselves into a position to where we maintain buying power so that 100 grand is still operating like 100 grand. We want to make sure that we're avoiding losing money. Where are you putting your money in places to make sure that you are guaranteed not to lose any money? Warren Buffett's number one rule is never lose money. His rule number two is see rule number one. So let me ask you this. If you have your money in places to where it's not growing for you, which means it's not beating inflation, and you also have the opportunity to lose money, does that sound like the safest place to be able to put a majority of or the lion's share of the money that you plan to live on and to be able to have access to and to utilize for the foreseeable future? Could be a little questionable. But what if you can never lose money again? Now, if you're like myself, you're probably somebody know who's ever lost money. I'm sure that's a hand that gets raised, right? Now, markets recover. So this is talking about stocks, it's talking about cryptos, it's talking about real estate. Markets recover, but accounts don't always. It's not equal and even across the board. So when it comes down to these risks, we have one of three choices. Either we can avoid the risk altogether, not be in the market, not have our money anywhere, but then we're exposed to other risks. We can retain the risk, which means that anything that were to happen, you're holding on to it, whether it's up, down, or sideways, it's on you, or we can transfer it by using insurance to be able to buffer the problems and the perils and the pitfalls. And at the end of the day, longevity, the longer that we are around, the more that this multiplies every other risk associated to our finances. Because who knows how long we're going to be here. And at the end of the day, I don't think that just because you're old or because you're age advanced, they're going to say, let me start giving you a discount on everything. It doesn't really work that way. So those expenses continue to be in place. Where's Warren Buffett's rule once again? There is never forget the rule number one. Now, this is something I want to take a moment to dig into. If I were to ask you before, what would you have thought to be the number one cause of bankruptcy in America? Um, what would be the number one cause of bankruptcy in America? Most people have thought divorce. Some people have thought, you know, some people have thought stock market crashes. They thought of a number of different things. But at the end of the day, it is actually medical costs, mainly due to long-term care. This could vary from state to state, but I want you to take this time to look and Google what is the annual cost of long-term care in your state. For those that are here local in Florida, I'll go ahead and save you the time of looking it up. The average cost in Florida is $117,000 in the state. Now, once again, talk about inflation. What is it going to be by the time that we need it? 20 years from now, it's projected to be over $200,000. Now, I'm gonna tell you right now, the average 401k by the time someone has to access it is anywhere from $300,000 to $400,000. If people don't have that money on them now, what is the likelihood that they'll be able to have that to be able to take care of them 1, 2, 3, 4, 5 years from now? Something to keep in mind. So for these unforeseen circumstances, long-term care is if somebody would have cancer, heart attack, stroke, critical illness, chronic illness, terminal illness. This is the money that could be there. Instead of coming out of pocket, you can have the insurance money pay it first. So you can keep your home. You don't have to downsize. You don't have to cash out your 401k or your stock portfolio or anything. You can use the other money first. And long-term care is actually a woman's issue because they outlive men. So if you saved up all of this money in different areas in different ways and what's left behind, when a man passes, if he had a long-term care need and a lot of his resources were taken care of to be able to take care of that, what does that really leave for the woman? Something to keep in mind. There are a number of myths about long-term care, about not needing it or not having to have something in place, but the numbers speak for themselves. Like I said, I don't know who wants to kick out $117,000. And this gives you the opportunity to retain dignity because the last thing that a parent wants to be is a burden upon their children. So if they had the option, if you had the option, or your parents had the option, would they rather be able to stay at home, go to the long-term care facility of their choosing, or to have to move back in with the kids and the grandkids? That independence could be a choice of yours, but that comes with finances. And the ins and outs, there is no plan that is complete without a long-term care need being addressed. Right? None of us are exempt from unexpected healthcare costs, especially as we age. Master Apollo. All right, bear with me 1 second. Ooh, moving too quick. So when it comes down to it, so when it comes down to looking over what are the options out there when it comes down to life insurance, you have term. Term is what I call the peace of mind policy. As long as you have it, you're protected. Now, the challenge with the term is that it does expire. But the thing is, you're supposed to buy a whole lot of term, especially when you have a majority of your responsibilities in place. So, for example, when you have the home unpaid for, you can have a term to cover that. When the kids are still young and you want to have something in place to make sure that they can go to the school of their choice, or to have the flexibility of their choice, or to have that down payment for their home down the road while they're young, you want to be able to have these policies, these income replacement. If something happens, God forbid, too soon, you have that. So, like I said, they're very affordable. You can buy huge policies at a very affordable rate. And there's even something called I call the new life insurance, where you can have a refund option. So imagine if you have a policy in place for the next 30 years and 20 years or 25 years in, every dollar that you put into the policy, you can get it back. Now, I want you to think about that in the sense of what if you had State Farm or Allstate or Geico for your auto insurance, and you had that for the next 15, 20, 25 years. And they reached out to you and they say, hey, Janice, I appreciate, your time for being with us. You haven't really had to use our services. We want to let you know if you would like, either you can keep on paying for this policy to keep the coverage, or we'll give you a 100% refund. What option would you like? The new life insurance, there are a term, which means policies that can't expire at a certain point that you can use to utilize a full refund. And the great thing about these two is that they also include long-term care. Hmm? Now, this is probably something, or it's already shown what the benefits are, but if you were to Google, what is a LIRP, a LIRP? If I were to give you a little bit of information to be able to look into, there's a man by the name of Douglas Andrew. He's an author. He's written two books that are absolutely phenomenal reads. One of them is called The Power of Zero, and it's how you can operate your or get yourself into operating with a 0% tax bracket. The second is a book called Look Before You LIRP. And a LIRP stands for a life insurance retirement plan. Now, in this plan, the way that they're designed is that these can be designed to last up until 121 years old. Now, normally I tell people, I say Moses only made it to 120. So if you find a way to make it past that, I mean, you clearly have lived in the fullest life more than almost any man on the planet. So if anything else were to come from that, essentially this is what this will say, Deborah, that this money is a permanent insurance policy guaranteeing that this money is being able to be passed along to your beneficiary, whether that being a person, persons, or any entity with that face value that I broke down earlier. The cash that is growing inside of this policy is accessible penalty free. If I were to compare it to your 401k, before 59 and a half, there's a 10% penalty that's assessed. This non-provisional, meaning that this money does not count against your income when it comes to measuring your social security or your taxable funds. There's no income limits. Once again, we're pairing this to a retirement plan, like a Roth IRA, for example, where if you make too much money, you don't qualify, or you can only put but a certain amount into the policy. Earlier, I mentioned the required minimum distributions. There are none. So the cash that is accessible inside of your policy, you can get access to that cash without having to worry about having to take out a certain amount of money at a certain time or being penalized for not touching that money. And one of the beautiful things I mentioned it with the no income limits as far as the cap, but also similar to the 401k or a Roth IRA, there are no contribution limits. So you can design these in a way where you can put as much money as you're able into these policies to be able to get all of the growth tax advantaged. Now, in the new life insurance, you've probably heard out there on maybe Snapchat or TikTok or Instagram or YouTube or one of these things, you can be your own bank. I'm sorry, one second. You can be your own, you can be your own bank, meaning that if you needed to have access for a down payment, if you want to use this for schooling, if you want to use this for any option that you normally would either go to a bank for or have to get loan or do something else, this money would be available to you for you to be able to use it within your own family. Now, once upon a time, we had these things called deferred benefit plans, also known as a pension, which means that you essentially would go work somewhere for long enough to be able to get a guaranteed paycheck for the rest of your life. Now, what we know is that these have dwindled severely from a defined benefit plan to now defined contribution plans, meaning that the money that's over here used to be guaranteed. Now they've transferred the risk to you, and now you get to decide how long and for how much money you're going to spend for what amount of time. But what if you can save your money into a place that not only has this laundry list of benefits, but you can also turn that cash that's growing inside of the policy into a private pension offering you a guaranteed income, which is another paycheck for the rest of your life. Oh, and by the way, it also includes long-term care. If I didn't mention it before too, with the long-term care need, not only is it on average $117,000 a year in the state of Florida and expected to be over $200,000 a year in 20 years, there is a 72% chance of having a long-term care need in your lifetime. Now, I'm not a gambler, I'm not a betting man, but there's a 72% rank chance that you could possibly be facing a six-figure cost and expense. I would rather have something in place so that somebody else can pay for it, not myself. Anybody, I'm sure that if I were to ask for a hand raise, everybody would raise their hand on that. But I'd rather somebody else pay that money beforehand. Now, when you're thinking about what you're looking for your money to do for you, an acronym I say is LSRTH. You want your money to be liquid and safe, similar to the bank, where you know that the money is there, you can pull it out, you can debit it, you have access to it, you can physically grab it. It's safe, FDIC insured, which is why we have our money in the bank. We know that it's going to be there when we need it. But we also want our money to be able to give us some returns. And what's even better is even having the option for guaranteed returns and tax advantages. So not only am I going to I'm going to be able to make money, but I want my money to make money and to be able to have as much access to tax advantage money that I do not need to pay taxes on. But I also want to cover those healthcare costs. I want to make sure that if I'm picking places to put my money, whether it's in real estate, whether it's in the bank, it's in stocks, it's in crypto, where am I putting my money to where it is going to give me an additional advantage should I need it? Because let me ask you, who do you know who's had cancer, heart attack, stroke, a critical illness, chronic illness, terminal illness, Alzheimer's, dementia, or a laundry list of health concerns? And once they got diagnosed with that condition, everyone said, you know what? You don't need to worry about your mortgage anymore, or your car insurance, or groceries, or your light bill. The bills are still going to be coming. And if you had to think about what would be the best position to put yourself in, would you rather be in a position to where not only are you suffering from that condition, but you're also still needing to find a way to keep the bills together and dealing with that stress, or having the money to give you the options to be able to not only to get the care that you need, the care that you are looking for, but to be able to keep the main thing, which is to focus on the most important thing, which is our health. Once again, no retirement plan is complete without a long-term care plan in place. So what else can life insurance do for you? This isn't necessarily across the board. Not all life insurance companies are equal. However, there are a laundry list of benefits that come with it. Once again, you can turn this into a guaranteed income for the rest of your life. You can supplement your retirement income alongside everything else that I've mentioned as far as the other financial areas. You can supplement this to go alongside that. While life insurance legally isn't classified as an investment, you can diversify where you are placing your money to put it into the places to be able to serve you in the LSRTH space. You can create a payroll subsidy for those who have businesses out there that you can save this money up aside in case there are hard times or maybe a bonus or a number of different offerings, but having this money to be available for you to be able to cover expenses is always a win. And you can use this as mortgage protection. So if you heard about mortgage protection, like making sure that your house is taken care of, that M that's within the dime, you can use this for that. You can use this to fund the family trust. Once again, you can go to the attorney to get that in place, but you can have that trust, which is like having a life insurance policy upon passing is like having a money go into turning into a champagne bottle that you're pouring into a champagne fountain. So it's going from one glass, you're filling up that top glass, which spills down to the next four, which spills down to the next eight, which spills down to the next 16. So what have we just created by having a proper plan in place with the power of life insurance? Generational wealth, to where we're taking hundreds of thousands, if not millions of dollars, and passing them from one to the next. Not just willy-nilly, like just throwing out the money and then hoping the family figures it out, but having a proper plan in place to dictate how you want this money to be spent. You can use the same plan and use the life insurance, the cash inside of the policy, use it as a college fund. You can get a 529 plan, but what if they don't go to college? What if they make a different plan? What if they take a different choice? What is the flexibility that is offered to you in that when you can still have this money to use for whatever you'd like? Of course, we're talking about income replacement because if somebody we know, love, trust, and care about, we are relying upon to be able to help take care of the others that we know, love, trust, and care about, replacing that income could be a severe task. And something that this money allows you to be able to do is to be able to grieve properly. Like to be able to make sure that you don't have to rush back to work. You don't have to rush back to clock in. You don't have to get back to the ins and outs of the day to day because you have something in place that you can take your time to really dig into yourself and into your situation and to connect the dots and to really find peace before you have to be forced into another space. So income replacement is very key. Tax advantage savings plan, because there's nothing like being able to have, if you're going to have some money, I would, I mean, you tell me, would you prefer that money to be taxed later or to be taxed never? I prefer my tax advantage. And then for those other ones out there, if we want to make sure that if you have a business going on, you may have heard of key man insurance or employee insurance, people that have a integral role into our businesses. If something were to happen to them, how do we make sure that we have some resource in place that can make sure that we keep that ball rolling? Self-insurance is a fallacy. Either you have insurance or you don't. If you have an iPhone and you either have the Apple Care coverage or you don't. You either have car insurance or you don't. And the thing is, when you're going down to it, if you have the need and you do not have it in place, it's better to have it and not need it than to need it and not have it. So life insurance is time. Time a man may not have. If he needs time, he needs life insurance. Tom Hegner, who actually spent over 20 years as the vice president of New York Life and now travels the country as a phenomenal author. As a matter of fact, I would also look a book. I'll leave some people with real quick. You're looking at Tom Hegner. You're looking for a number of different resources. Matter of fact, as I come to a close here, what would the Rockefellers do? Phenomenal resource if you want to learn more about life insurance by Garrett Gunderson. Don't worry, retire happy by Tom Hegner. Gotcha by Matt Sapalo. Talks about the perils and the pitfalls when it comes down to navigating the 5 pitfalls of financial freedom. And if you want another book, reach out to me. That's what I have my contact information here for. I can give you some more resources. So, would you rather the cost of the solution or the cost of the problem? Either way is going to cost you. That handsome devil right there would happen to be me that came up with that. So, if there's any insight or value or service that would make sense to have a further conversation, please check out my contact information right here. You can go on there. I'm always on Instagram. You can send me over an email. If you call me, leave a voicemail or shoot a text. If there's any questions that I can answer, if there's any family members, people you know, love, trust, and care about that can use this kind of conversation to put themselves into a better situation. Maybe they've been dragging their feet or maybe have some reservations in regards to getting their financial household in order. That's what I'm here for as a professional. As Dr. Brown said before, this is a altruistic field, one of the most noble and significant roles that somebody can be in to speak about not only just money and finance, but to talk about community involvement, community engagement, being a financial resource, economic education, to really have real power that you can use to be able to cause those changes that are not just make turn those idealistic goals into realistic goals through the power of finances. So with that, I appreciate it. I'm gonna go ahead and I'll leave that up for just a moment. And with that, Dr. Brown, I appreciate your
Yeah,
time for giving me the ability to do this, but I will put it back into your the ball back into your court for you to,
yes,
carry it through.
please let your information screen still because someone asked about your contact information, which is good. And I do thank you very much for that, Kudarie. That was a wonderful presentation, very insightful and informational, and I'm sure our panel would agree with me, or our attendees would agree with me. But can you say what are the key differences between term life insurance and whole life insurance?
Okay, great question. So when it comes down to there's term and then there are permanent options. And I can go down that rabbit hole. There's different kinds of permanent
Mhm.
policies, whether there's the whole
Okay.
life, there's the IUL, there's a final expense, but there's different kinds of permanent options. Essentially, the biggest difference between the two is term is temporary, meaning it lasts for only a period of time. So it could be 10, 15, 20, 25, 30 years. I've seen as much up to a 35-year term, but a term only lasts for a specified period of time versus the permanent policy. It can be designed to last up to age 121.
Mm,
The term option
okay.
does not build cash. The permanent option has the ability to generate cash. The term option is much more affordable because there's a likelihood that it could expire without payment, meaning you either outlived it or canceled it. And then the permanent option, it comes with a lot more of the bells, the whistles. I call it that's like the Ferrari when it comes to life insurance products, as far as having a permanent option or a proper permanent option to fit your prosperous financial plan.
Okay, perfect. Thank you. Thank you for that. So, how does life insurance, you have served in leadership capacities. We have doctoral leaders here, we have leaders in general here on our viewers. Um, how does life insurance fit into a leader's overall financial and legacy planning?
Mhm. So in a number of ways, I think that if, as a leader in your household, if you're looking at it, what are we looking to make sure that we are doing for our loved ones? For the leader in the household, you want to make sure that you're passing on blessings and not burdens, which is why
Mm,
you're addressing the dime method. You want to make sure that the debts are covered because we're not passing that on. The income is replaced. We want to make sure that there's a roof that stays over our family's head. And for any of the children that are in the household, we want them to have the opportunity to be able to have the education that, had we been here, we can assist them to be able to provide for. As a leader in business, there are a number of different ways that you can use this as an advantage. A leader in business, you want to make sure that your business can continue to operate as a legacy plan beyond you. So if something were to happen to you, whether from a critical illness, chronic illness, or a terminal illness standpoint, and you lead on to pass away, what is going to be the financial resource that you can rely upon to execute the plan to make sure that your business is still going to be here for the generations that you may want it to exist? Not only
yes.
that, from the key man, the key insurance standpoint, the key employee, I want to make sure that my fellow executives, for the people that I know that we're relying on as we're building this business and continuing to scale it and take it to the levels we're looking to take it, I want to make sure that if I were to happen to lose somebody, that we can use that as an opportunity to, I was gonna say replace. It's hard to really replace that person, but to find someone else to be able to fit those shoes. So while we may be able to lose that person from not only from what their offerings are, we could try to be able to have those finances and resources to keep the business afloat and to find someone else who can come and make sure that we keep this business all together.
Nice, nice. Perfect, perfect. Because with this part of it, we want our viewers to to have a fundamental understanding of life insurance, right?
Mhm.
So you did answer one of the questions because I was going to ask you about the terminology. Well, the question is, why is it important? And maybe you can elaborate some more because a lot of people might not understand fully why is it so important and determine the terminologies because you have mentioned some terms during the presentation. So why is it important for leaders to understand the basic terminology used in life insurance policies?
Yeah. I think it's very hard to get complex until you understand how simple things can be. As
Mhm.
a matter of fact, one of the best quotes I heard from one of my coaches was he said, the hardest thing about this business is how easy it is to complicate it. Like it's very simple the way things operate, but you try to make do extra things and so on. But understanding the terminology allows you to be able to best take advantage of this tool for how it best suits you. So to go back to my initial question, I asked, what is the most valuable thing to you financially? What do you value
Mhm.
most financially? So in that Swiss Army knife, in that utility tool, it comes with it's a knife, a screwdriver, a bottle opener, a corkscrew, the scissors, pliers. There's so many different tools that come with that Swiss Army knife. But when you understand the basics of what it is, and then you can start finding out, okay, this is the one tool that it is. It's the Swiss Army knife. But for me, the most important thing for me may be utilizing the life insurance, which is the knife.
Mhm.
But
Yeah.
it might also be, okay, well, for the projects that I'm going into, the space that I'm moving into in life, I may need to more so utilize the screwdriver and the corkscrew part of it because I want to make sure that I'm growing money in a space that's tax advantage while also covering my health care as a just in case as well. So really, I
Mhm.
mean, while all of these things are being included, understanding the terminology that's within it can better help you leverage this tool to be able to do it. Because I mean, there's some you can't fix everything with a knife, and you can't fix everything with a screwdriver. But the better understanding you have of these tools, the better you can apply those tools to the proper project that you're facing.
Nice, nice. Thank you for that. And viewers, if you do have any questions, please feel free to ask. Um, and I have another one though, but what is the role of beneficiaries in a life insurance policy, and how should our leaders here choose them wisely?
Okay, how can you choose them wisely? I would say that I can't tell you what beneficiary to choose, but I would say that because it's not only a beneficiary is not only a person or persons, it's also an entity. So it's a matter of choosing who or what do you hold near and dear to your heart.
Heart.
That's really the best way that you're able to put it. My suggestion is that you're selecting someone who's at least 18 years or older, because at the same time, if they are under 18, it goes to the court and it's held before it's able to go to a
Yeah.
minor. So that's the reason why you can have the trust and you can have a little bit more control. But when it comes to choosing your beneficiary, who do you think is going to execute on the vision that you have for these expenses? If their
Mhm.
kids are over 18, you're making sure you're passing that legacy. That's a great option. If you don't have kids and you have siblings and somebody else, who are you looking to take care of? Who are you looking to pass it along? But once again, even entities, if you want to leave it for a charitable organization, you can look to do so. You want to leave it for a church, you can look to do so. There are so many things that in our life that we're looking to commit our most valuable resource to, which is our time. So throughout that, upon our passing, we can still be able to have this to be able to carry it on so that the work that you were doing while you're living, you can help to finance that to keep that going too. So honestly, like as far as picking a beneficiary, I would say somebody that is hopefully close, you know, and someone or some entity that you know, love, trust, and care about.
Nice, nice. All right, thank you for that. And that's interesting because when we do, I remember someone bought a property and he put his daughter, which is a little baby, on the paperwork, and he passed away. And now the daughter can't do anything because she's just a minor. And
Mhm.
his mom, which is her grandmother, passed away, and now this child is just left to wonder what's going to happen and what's going to happen to the property. So that's a very interesting thing to make sure that an interesting point to note that the individual that you are choosing should be of a responsible age, 18 and older, so that they can act accordingly. So as we look
Yeah.
at, and so thank you for that, Kudari.
Oh,
As we move on to the strategic and ethical considerations, right, of life insurance, how can leaders use life insurance as a tool for wealth transfer and generational impact? How would you say that?
okay. How can leaders use life insurance as a tool for generational wealth transfer and impact?
Yes.
Yes. And then after this, I believe Dr. Nelson may have had something. I saw her unmute for a moment, so I'd love to be able to get to her if she had a question. So how could you a leader can use this? This is to go back to Ed Slott, who was talking about taxes and he's America's CPA, and I believe also Tom Hegna. They have, I believe, now I don't want to misspeak on their behalf. If not, I also believe whichever one of them had said this, is that it is the greatest wealth transfer tool that we have access to. Because for pennies on the dollar, so literally for a fraction of the amount that we're actually putting in, on the backside, we're getting multiples of that we're able to pass on from one person to the next. From an estate planning standpoint, if you have an estate tax and you have these things from all of this money, why not go ahead and have the insurance money to be able to cover that so you're leaving your family with more? If I can put in $100,000 over the course of time and leave my family with millions, like we're literally beginning something. But what it also does, and Tom Hegman speaks to this, he has a joke. He says, for this is for all my parents out there, my parents and my grandparents out there, don't leave your kids a single red cent. Leave them life insurance. So when you're thinking about your money, you're thinking about your resources. You've worked your whole life to be able to build up your resources and your assets, to be able to use them as you will. But if you're thinking, how much am I going to leave behind here from my cash and my stocks and my real enjoy that. Enjoy it. You worked for it. You built it up. You did that. Especially if you have life insurance aside. So if I know that I'm going to be leaving my children $2 million, $3 million in life insurance, then whatever assets I have that I've built up, I have a lot more flexibility in the use of them because I know that no matter what I do here, I've already taken them care of over here. So from a wealth generation standpoint, essentially, especially with a permanent option, unless you live to age 122, 23,
Hello.
25, right? Unless you're doing that, you're essentially putting yourself into a position to where you have a contract that has the promise of paying the face value or the death benefit X amount of dollars.
Yeah. Okay, that's interesting. That's interesting. And it leads me to this point because you mentioned something earlier about an organization. 'Cause many of us have organizations, are part of organizations and all of that, businesses and all that. Um, you mentioned about having an employee who plays a critical role in the organization, and what if we lose that employee? So
Mhm.
my question is, how can leaders integrate life insurance into employee benefit packages to retain top talents?
Mm, that's a great conversation. For anybody who is in that space, that it's better flushed out one-on-one to find out how it is, but especially for
Hmm.
our key executives. So for example, if you're the CEO and you have a CFO, a COO, and insert another dot O position,
CTO?
yeah, right. A C-suite executive. For your C-suite executives, some people have even referenced to them as golden handcuffs, to where you're not only giving them insurance or you're putting a life insurance policy on them, but that same tax advantage cash that's growing inside of that policy, you can use that cash to become a bonus for that executive. And you also have the control. For one, it can be selective. So you don't have to give it to everybody. So you can choose which executive you're giving what amount of coverage to, and then what money is also going into that to determine how much the growth you're going to get, which you can turn into a bonus. One of the very
Yeah.
famous ones, for example, there's if you hear of CEOs or if you hear of NFL coaches or some of these people getting these big, huge bonuses,
So
tax free or
you know
tax
what I
advantage.
did with what I had,
Oh, so
because you talk, yeah.
we got somebody
Dr.
else on.
Whitfield? Dr.
Yeah.
Whitfield, you have a comment?
Unfortunately, my my bill.
I think
Yeah,
he muted.
I
I think,
appreciate your
yeah.
time. I gave him a quick mute. So okay, so what was I was referring to the oh yes, you can so that money that's growing in there. So the NFL, like the NFL, there's been NFL coaches who've done it, CEOs that do it, plenty of them. They're putting their money into these as a part of the package. They're funding these insurance policies and then bonusing themselves back the money. So think about it as a COO, CFO, C-suite executive, if you're getting an additional X amount of thousands of dollars of bonus cash that's tax advantage that you don't need to worry about. I mean, that's a pretty good what they call them a golden handcuff because it's like, yeah, I could leave, but look at what you're leaving behind. So it is a tool that executives tend to or have access to being able to use to retain good talent, to protect good talent, and to also, provide them with additional benefits.
This is some good information. And I see Jennings was like, yeah, this is some good information. So thank you for that. Thank you for that. How in what ways do you think life insurance serve as a funding mechanism for business succession planning?
Oh, in the same concept of, like I said, if somebody were to pass away, at the end of the day,
Hmm.
there may be some, depending on how solidified the plan is. Let's say that you've had a father who's been in business for the last 40 years and is passing it on to his son who's only been around for two. Things may not be able to operate at the same level of efficiency and effectiveness upon his passing. But if we were to at least have a safety net that can be there to make sure that if there's any additional taxes, debts, liabilities, concerns that might come along with that, you can use that money to help fill out some of the gaps or some of the differences in the meantime. So upon somebody's passing, I think at the end of the day, what money is energy, and money provides options. And really, it provides a certain level of safety and certainty. So, with having that capital available, especially in regards to business, if it were to be earmarked for certain business endeavors, that could be something that money could easily be used for, with that proper plan being in place, with a direction as to how those funds are to be used to be able to make sure that the business is able to go on for another 40 years if the family chooses to do so.
Okay, perfect, perfect. This is such good information. And as when we first started talking um Kudari, we did mention something about the understanding of life insurance. And there is so much information that as leaders, we are so caught up in the busy life and not even understanding or realizing what and how important this thing called life insurance is. Um, which leads me to my next question. As you were talking, I was just making some notes and see if I can, help our audience. And please feel free, if you have questions to ask, please feel free to ask. How can leaders use life insurance? And I'm sure maybe Jenny's would be excited about this one. Life insurance as a tax efficient financial planning tool.
Okay. I'll, so to go back to the question I asked before, I asked all of my clients, legally, I can't say. What do you think? Do you think taxes are going to be higher or lower in the future? Now, if you thought that it could be higher, right? If taxes are going to be higher in the future, are you putting more money aside today in places to where you're going to have to pay more taxes on it in the future? And if the answer is yes, my follow-up is, how much sense does that really make? Because they probably hadn't thought about it because generally speaking, a majority of people do what the majority does. And a majority of people put their money in the place where everyone else does. So when we receive the 401k, the 403b, the TSP, or whatever our retirement solution is, normally it's from HR, they're just sliding it over to you. Here are your benefits, you check the boxes, you take it. And I was under that same assumption for almost 10 years working in corporate America. I assume I got my 401k, I'm good. Like, what else
Yes.
do I need? I'm going to work. I'll have a few $100,000 by the time that it comes, but I'm not going to question it. But then in 2020, when the pandemic came, I lost 40 to 50% in my 401k. So what if you have hundreds of thousands of dollars in your retirement plan and then the market takes a dip because there's a war or a pandemic or a recession or a depression or an insert who knows what, right? Because the market could be wonky. And then if you're in
Hmm.
your 60s, 70s, 80s, what is the amount of time that you're willing to wait for that money to be able to recover? Now, that's talking about the money side, but you've asked me about taxes. Let me ask you this. Do you know what at the highest amount, because I know there's different brackets, right? Do you know the highest tax that we've ever paid in America? If you were to take a guess, matter of fact, Dr. Brown, since I have you here, what do you think is the highest tax percentage that we've ever paid?
I will go with Janice's response, 78%.
78?
Yes.
Higher.
Whoa. 82?
One last try. Higher.
Come audience, anyone want to help me with this one now? Come on, anyone
Last,
else?
last one. Last one. Higher than 82.
Dr. Whitfield said 89.
94%.
There we go. She Googled
There we,
it.
oh my.
94% is the highest tax,
Wow.
highest bracket that we've ever paid. Now, since we went up, because at one point in time, taxes weren't supposed to be what they are today. But since they crossed that certain threshold, they pretty much become normalized. And since then, for the last few decades, we've been among the lowest tax bracket that we've been in decades. So there is a chance that taxes could go up. Like I said, legally, I can't say. I don't have a crystal ball. And if I knew, I'd move a
Mhm.
little different. But with us not knowing where it can go, whether up, down, or sideways, when you're looking at places that you're diversifying your portfolio to enhance that portfolio, putting your money into a place that's tax advantaged, that if taxes go up, your money is still going to be safe and going to be there for you. If your money's also growing and beating inflation to the tune of 5 to 8% on average year over year, you know that even if inflation is going up, some years are a little crazier than others, but your money is consistently growing, you're maintaining buying power, and you're not leaving it subject to the harshness of a potential 40, 50, 60+% tax that could be levied at, who knows what time. So, but once again, it goes back to those perils, right? Talking about TILL, taxes, inflation, losing money, long-term care. They need to be accounted for. And I actually just kind of still working out this acronym. I said till the soil. So you have till, TILL, soil, your solutions for your objections of your solutions for your objectives with your investments long term.
Nice. Thank you for that. And thank you, Dr. Nelson. Thank you, Janice, and thank you, Dr. Whitfield, for your participation. That was so much fun. And it's interesting because to know it's that amount that high, well, wow. Which
It's been
leads
there
me
before.
to,
That's all I'm saying. I mean, hopefully, we'll never see that again. However, if it's been higher than 32% before, I'm just saying that
uh
I'd rather keep as much in my own pocket than that uncle I've never met named Sam.
I know, right?
Mhm.
Which leads me to my next question, and I hope this is helping a lot of us. What are the risks of being underinsured or overinsured? Again, what are the risks of being underinsured and or overinsured? And how can leaders assess their appropriate coverage?
I, I'll start with the latter part of that question. What are the risks of being overinsured? I will say that there are none. I don't think that there is someone that can come out and say, upon their passing,
Absolutely right.
they look down from heaven and say, dang, man, I left the family $10 million. I left them too much. I don't think that that's not something like to be over insured. Like this is legacy money or that long-term care side of things. Because if you need it, you want to be able to have it there. Now, on the flip
Mm-hmm.
side of that, though, to be underinsured, oh, if you're underinsured, that means when you're passing away or when you're going through something, you don't have the debts that are covered. So you're passing on burdens and not blessings. To be underinsured means that upon your passing, your family, how quickly they would suffer a financial impact by you no longer being there to be able to provide from them. Being underinsured means that we don't know how long they'll be able to keep a roof over their head or the roof over their head that they currently have. Do they have to change their zip code? Do they have to move back in with family? Do we have to make sure that those things in dime aren't taken care of? Of course, you can go out and get your scholarships and you can go find a way, but what if you had a plan to be there to provide in a particular fashion, and then now that's not there for education? So being underinsured would be leaving yourself open to all of the perils, the problems, and the pitfalls that could fall upon a family for not having this resource in place. Even more so, the long-term care need, because I mean, I can go into several stories of having a family member with, if he didn't have insurance, now it wasn't long-term care, it was insurance still nonetheless. There was a $250,000 bill that was due. And fortunately, due to insurance, there's a zero at the bottom of that. There's
Mm-hmm.
one of my coworkers, a younger brother who's in his mid to late 50s, has full blown Alzheimer's, and they're paying $5,000 a month right now as a family out of pocket, and they're suggesting that he needs skilled nursing care, he needs more care, which is going to cost anywhere from seven, eight, $9,000 a month. So to be underinsured is to leave yourself subject to having to pay for these things dollar for dollar out of pocket versus pennies on the dollar to leverage someone else's money, right? You want to be able to use what's it called, OPM, other people's money.
Mm-hmm.
So, like I said, unless like self-insurance is a fallacy. There is no such thing as self-insurance. Either you are paying for it or you are not. So I would say,
Okay. Nice, nice. Thank you. This is some good information. Along the your presentation, you mentioned about leaving as a beneficiary. It doesn't have to be an individual, a
correct.
person. It can be an organization. So, how can life insurance be part of a leader's philanthropic or charitable giving strategy?
Oh, absolutely. I would say this. Hey, you can make, if you're going to give your 10% while you're here on this earth, you can give 10% on the way out too. So if you want to be able to, if you want to be able to, if you want to be able to pick whichever that organization is, like I said, once again, that goes on you. So you can go on there and you can choose to exercise a particular percentage of that given. So if you wanted to leave 80% to your wife, 10% to your business organization, or 10% to maybe a food pantry and 10% to church, you'd have that flexibility. So as far as somebody looking to leave something, maybe they want to say, hey, listen, I have $2 million in coverage. I want to leave a $500,000 to this educational platform so that they can build a library to do X, Y, and Z on our behalf. Or to do something where I'm investing into this AI capabilities or coursework or something to be able to have that last name. Because I mean, we see it all the time. We see libraries, we see buildings, we see statues, we see people who've either had successes and mighty achievements in life, or they've had phenomenal philanthropic successes that they've been able to give in these charitable ways. I'm not saying that all of them did it through insurance, but what if
Mhm.
you could?
Yeah.
Mhm.
Yeah. Yeah. That's very interesting. And that's very good. It's good to know. It's good to know. Um, one other thing I maybe should have asked earlier, and this would maybe help, is when it comes on to the policy details and decision making, right?
Mhm.
What factors determine the cost of a life insurance premium, and how can leaders optimize them?
So there are a laundry list. Great question. There are a laundry list of things that you need to go back to that, though, that terminology I said in the underwriting. So that
Hmm.
goes based on your height, your weight, your height, your weight. You can't control your age, all right? This is what it is. Your height, your weight, your age, your driving history, your criminal history, your medical history, your prescriptions, surgeries, procedures, things that you've disclosed to your doctor. All of these things are taken into account in the application phase. And then the insurance carrier is going to do their due diligence. They have a case manager and they have an underwriter. They're going to go and check your medical records, your criminal records. They're going to go check everything on their end because if you're looking at it, once again, they're trading pennies for dollars or they're giving you dollars for pennies. So they're making
Hmm.
sure that if I were to give Dr. Brown $1 million, I want to make sure that my investment checks these parameters. So as far as some of those things, I would say maintaining a healthy weight, not smoking because smoker ratings are just going to be a lot more. The healthier that you are, not only could you be, I mean, the worse off your health could be, you can be called rated, which means that it's X amount percentage higher as far as the costs go based on those parameters. Or if you're very healthy, if you're within certain ranges, your weight's in a great space, your blood pressure, your cholesterol, all of these other different health related statistics, if those are in order, then you can also get a better rating. And you can go, for example, select or up to even an elite. Some companies call it different things, where you can get more insurance at a discount. So I would just say overall general health, height, weight, driving record, criminal record. Um, if I didn't say medical again, I think having those things in mind, and just because you do have a pre-existing condition, depending on the status of that condition and the nature of that condition, as in the severity of it, you still may be able to qualify by speaking with a professional who could shop around to different carriers to see if there is a good fit for the product that we're looking to put somebody with.
Okay, nice, nice. Thank you for that. Thank you for that. And let me just say to our viewers, our Zoom this evening is sponsored by Monar's Enterprise. So please, if you're not familiar with Monar's Enterprise, we're on LinkedIn, Instagram, YouTube, and TikTok. So please follow, like, subscribe, and share. This Zoom presentation will actually be on the Association of DSL Professionals YouTube channel. But please, if you're not familiar with both organizations, please follow us and subscribe to our socials. All right. So as we wrap up and we wind down, if you have any questions, please share. And I just have a few more as Kudarie, you were making your presentation. What are the pros and cons of converting a term life policy to a permanent policy?
Oh, I didn't even get into that part. So now you're jumping the gun, giving us some extra nuggets there, man. So
You don't have to go too much, but
right.
some of the
No, it's fine. It's fine. So one of the benefits of at least the carriers, I'm not going to speak for across the board, but the carriers that I work with, if they do offer both term and permanent options, you can do something within a certain period of time on the term, you can convert it. So for example, I'll speak to one carrier. They have a 10, a 15, a 20, and a 30-year term policy. So that means the policies are good for those amounts of time. For the 10-year, the uh, for the 30-year, you have the first 20 years of that policy to be able to convert it, which means you can upgrade a portion or all of that policy into a permanent option. Because from the insurance carrier's mind, if we're on the hook, whether it's in the first month or in year 20, something were to happen to you that we need to pay out on, we've already had the contract, whether it's a term or permanent. So upon converting it, you don't have to do any more medical history, no no additional paperwork. There's pretty much you're just processing the change from term into permanent, and whatever the amount that you move from the term will now reduce the term by that much. And now you'll have a permanent policy in place that now is going to be, if designed properly, it can last you up until 121. You can build up some additional cash that's inside of that. And you just know that you have an additional policy that's there. But it's going to be rated at the age that you convert it. So if you get one policy at 30 and then you convert a policy at 35, this new policy will be rated at age 35. But it's kind of like turning in the keys from a Lexus to a Ferrari. So you still get those additional benefits as long as you can afford it. Hey, by all means, have a blast.
Sounds fun. Sounds fun. And that's good. That's good. And from a cultural, ethical, or even social perspective, right? How would you say leaders should handle life insurance discussions during estate or end of life planning conversations? Because one of the things is that we fail to talk about death. We fail to talk about life insurance. And the Bible tells us that death is a part of life.
And
So people
and a wise man leaves an inheritance to his children's children. So let's talk.
exactly, exactly. So, we have to get into the habit of having some discussions. It's gonna be some tough one, it's gonna be some emotional ones. It's not gonna be some comfortable ones either. So, how should leaders handle life insurance discussions during estate or end of life planning conversations? What are your views on that?
Mm, End of life and estate planning. If you're a leader, I say one, you can't run from the conversation. Because at the end of the day, no matter the day that we're born, we know that, you know what I'm saying, the end date's already on the clock. So if it's going to take place anyway. Now we don't know the nature or the time or the possibility of what it could look like. We don't know what that'll be. But when it comes down to talking about end of life, it goes down to what do you want to leave as a part of your legacy? So even though I said about dime, I said the DIME, there's even DIMO, just putting an L on the end. And the L is literally just for the legacy. What is that amount that you would want to also leave for the means that you want to be carried out for your family? Do you want do you want that money to be able to be there to serve as your a representative of your last name? Do you want that money to be there as something that's going to continue a job that you've yet to be able to finish? Do you want that to be able to serve as something that speaks to your morals, values, and principles? I would say that when it comes to the end of life, I mean, at the end of the day, if you're accounting for burial costs, that's one thing. But then it's like, but then what else? Are you leaving the generation? Are you leaving the people that are still here in a much more favorable position based on the things and the decision that you made? Like I said, someone is sitting in the shade today because of a tree someone planted 20 years ago. So it's like, what is going to be the fruit of the trees that you've planted? And that could vary for everyone. Someone would say, hey, listen, I'm going to leave 250,000. And that can make a world of difference. Somebody might leave millions and continue to make a world of difference. But when it comes down to that, it's just looking at what is the impact that you're looking to make upon that time, and just having that conversation with also making it make sense though. Like it all has to fit within the bubble and things. So if you want to be able to have a policy that grows, it's something that's permanent, and you get the death benefit or the face value of the policy plus all of the cash that you built up inside of it, all of that going to the family, that could be a part of your plan. Or if you just want to make sure that, hey, I just want to pay for some insurance so that I can spend all of the money that while I'm here into the way that I want to, the way that I foresee my life going for me, because I've already got my legacy plan in place. I already have the stipulations in place for how I want my family to be able to use this money and to leverage this money. So now that that's set, hey, listen, I've done my part.
Yes, yes, that is so true. And um, some information was shared with me, and it is so crucial because when you look at something such as this or webinar that we're having and the topic that we're looking at, um, information is very, very vital.
Mhm.
And the scriptures also tell us that people perish because why?
Lack
Lack
of
of
knowledge.
knowledge.
There we go.
So I hope our viewers and our audience this evening are taking this information and looking at your own situation and ensure that we have the policies, the practices, the approach, and everything, right? Um, to empower ourselves to be prepared. And on that note, as we wind down, just the last question, excuse me, what emerging life insurance products caters specifically to entrepreneurs, executives, or even nonprofit C-suite executive leaders? What are your views on that?
Very phenomenal question. My personal opinion, I think every product has to fit the person for where they are, where they can grow into, and for once again, it comes down to what they're able to afford to. So even some of the financial concepts we talked about today, at one point they were reserved for high net worth individuals, the affluent people with, hundreds of thousands and millions of dollars to be able to take advantage of using these. But now that these products are available to us, I would say the LERP being a strategy, that life insurance retirement plan, as far as a strategy to be able to utilize, I think leveraging permanent life insurance is one of the best things that an entrepreneur can use and take advantage of as a solution for all of the problems and the pitfalls that I mentioned before, for the reasons that I laid out. We want to make sure that if we're putting our money in places, we want to make sure that if anything, it has an advantage against potential rising taxes. We want to make sure that it's growing and keeping up with, if not, of course, hopefully super exceeding on whatever the inflation is going to be. We want to make sure that we are taking care of long-term care costs so that we can keep more money over the course of time when those instances of those chronic, critical, or terminal illnesses, whenever those come up. And we want to make sure that we are not losing money along the way. And when I say that, I guess maybe to elaborate, is where a place that you can put your money to where you're getting the ups of the market. So when the market goes up, you're able to make money. But when the market goes negative, you flatline. So you're never going backwards. Either you're going up or you're going flat, which is similar to taking the stairs. So you're
Yeah.
getting something that's liquid, it's safe, it can offer you a guaranteed return. You're covering your tax, you're covering your tax exposure, and you're covering health without losing any money along the way. So as far as a tool, when I talk about, like I said, once again, it goes back to that Swiss Army knife when it comes down to this tool, that if you're looking at the tools in your toolkit, as far as one that could be your most reliable, one that could be the most efficient and the most effective, not only for the short term but for the long term, because these are designed to be utilized over the long term. If you can turn something into a guaranteed income while also having cash to make any investments or to cover any major life altering decisions, you have such flexibility and such a tool that no matter what you do, having this as the foundation of your financial pyramid, having life insurance at the bottom, then eventually having cash, then having real estate, and then having stocks and anything else somewhere in that mix. No matter what happens to the market that could potentially crash, as we've seen happen in 2008, as we've seen happen in 2020, and as we can foresee going any other decade going into the future, what if we have something that, if all else fails or as things fall back, it lands on this level of certainty, on this level of comfort, and these guarantees that we have these things in place. So
Yes.
I
This
would,
is
I would,
this
I
is
would answer
some
with that. And I think that something else you mentioned just now when you were talking about the word, but and it escapes me. I'm sure Janice might would be able to tell me where. But it was when Jesus made his sermon on the mount, he was saying, whoever heareth these words of mine, what I'm saying, and heareth them not, I would liken him to a foolish man, you know what I mean, who built this rock upon the sand. And then he goes on to talk about
mm,
building your foundation on the sand.
mhm.
And what happens when the storms come? And we all have storms that
Yeah.
come into our lives. So it's like if you're building your house upon the sand and then a storm's coming, and we know that storms are going to come and to go, like it's quite foolish. Versus
Yeah.
in hearing this information and thinking about whatever plan that I have in place, if I am missing any of these, if there are any leaks in my boat and I were to come up to this, how catastrophic can that be? So it would be best to liken yourself to the wise man who heareth good counsel, who heareth the word, and builds his house upon the rock. So that when the winds came and the storms blew and the rains came and they beat upon that house, it wouldn't have fallen because it was built on a strong enough foundation. So within
Yes.
all things to consider, when you hear information that does make sense, or you see that there's an area that could be enhanced, it could be fortified within other those other areas, it's good to just look at that total, whole financial picture to make sure that, when these storms come and as our time comes, we have everything in place, not only for ourselves, but for our plans for our future and for the things to come. And
Yes, awesome, awesome. Thank you very much, Janice, and thank you very much, Shar. Shar shared it, Matthew 7, verse 25. So
there you
let's
go.
not forget that. And as we wrap it up this evening, Kudarie, thank you very much. Any questions we have for Kudarie as he as we end our live or our conversation, Matthew 7, 24 to 27. Thank you very much. Thank you very much. Thank you very much. Kudar's information is there. Let's connect with him. Let's ensure that we are building a firm foundation. Let's make sure that we are putting our ducks in a row, and ensure that we are being good stewards because we're not here for ourselves. We're here for others. And as our audience of leaders, um, I must say life insurance can align with our long-term vision for the legacy, sustainability, and impact in many ways. One of those ways are legacy building, right? Whether it's through wealth transfer or philanthropic initiatives, as Kudari mentioned earlier, right? It could be we look at sustainability of vision, business continuity, endowment funding, right? Impact beyond your lifetime. And this is something that I shared with someone that as we become legacy builders, we want to ensure that we leave a positive impact because as we see with our political environment now, we want to make sure that we leave a positive impact. So the impact beyond our lifetime should be leadership development and intergenerational support. So by designing a life insurance as a tool for intentional stewardship, leaders can extend their influence ethically, financially, and don't forget, strategically, well beyond our lifetime. With that being said,
Amen.
thank you very much, Kudari. Thank you very much to our audience. Thank you very much for those who joined us at the last minute. Thank you, thank you, thank you. And for the last 2 minutes, Kudari, please share your final thoughts as we close.
Okay. Thank you once again. Thank you for the time. Thank you for allowing me a platform to be able to share my expertise. If anything, just looking for whenever you're putting any kind of prosperous financial plan in place and you're looking for what it is that you do, it's normally the best place to start is to make sure that you are you're overcoming and not overlooking the perils, the problems, the pitfalls that could be in your way to find solutions for your objectives and the things that you can invest into that long term. So once again, you're looking to till that soil. Putting a proper plan in place, it isn't overly difficult just to be able to speak with a professional to find out what your options are. Making sure that I guess one of the most important riders that are adding into it, make sure you are accounting for long-term care. If you do not have long-term care and you are paying for that life insurance policy and you have a comparable option, or even if it's just a little bit more, but you can make sure that you have that even better at no cost, it'll serve you and your family abundantly by making sure that you are passing on blessings and not burdens. And if you were to have any kind of health concerns, issues, or challenges, that you can make sure, what I'm saying, that you stay prayed up and you focus on keeping the main thing, which is a lot easier to be able to do when you have the financial capacity and the resources to be able to help fund that. So with that, once again, I thank you, and I think you said it just right, man. We're just making sure we're doing what we can now to make sure that the imprint and the impact and the level of significance that we're making on our communities and our loved and trusted ones, what we're able to do that by properly putting the right things in place.
Amen to that. Thank you very much, Kudari. Thank you very much again. Please, our Zoom tonight is sponsored by Monarchs Enterprise. And for those who are online. You can follow us on our socials and also the Association of DSL Professionals. Money can't buy you happiness, but it can solve a lot of problems. And on that note, we will end our session this evening. Thank you very much. God bless you. Stay connected, stay prayed up, and remember, leave a blessing, not a burden. Have a good night. God bless you. Thank you.
Take care. Thank you.
All right.